Hi, I'm Sameer Jain at Active Allocator. As you know, we track market research very closely, especially at this time of the year. So, some great research, a great outlook came out from a large Wall Street bank, and let's call them JP. The economic outlook is reasonable. The risk of recession in the next 12 months remains quite low, but global growth is going to revert to trend more quickly than expected. US monetary policy, of course, is tightening and trade rhetoric escalating, all of which represent downside risks. So, slowing economic momentum, tightening policy, they suggest that one should de-risk portfolios. Within equities, they favor the US, they least favor Eurozone equities, and bring emerging market equity to a small underweight in tactical allocation. They favor duration, and they've raised the cash allocation to overweight, especially for US dollar cash, where real policy rates are edging to positive territory. They are neutral on credit, but they note increased headwinds to fundamentals. So they see slowing earnings growth and rising macroeconomic risks, and they say the cycle is distinctly mature with limited capacity now to absorb shocks, and financial conditions are tightening with very little chance of reigniting the bull market in risky assets. The good news is the probability of a recession in the next 12 months remains very, very low. And of course, the pickup in capex that was anticipated hasn't fully materialized. So growth, as I said, is dipping back to trend more quickly than expected. The data outside the US seems to be a mixed bag. So in some, economic momentum is moderating, just as US monetary policy is quickly approaching, some would argue, as they do, is already in tight territory. They expect hikes to continue quarterly until mid-2019. But of course, tighter policy doesn't imply a looming recession. But in combination with softer growth, it makes for a more fragile economic mix in which business, investor, and consumer confidence may struggle to withstand negative news flows from issues like trade and geopolitics. The US has led through the cycle, and a weak market this autumn has failed to outperform, but earnings resilience of the US still continue to be superior to other countries and will be supportive, they say, over 2019. And by contrast, political woes are simmering once again in Europe. Recent earnings seasons were lackluster at best, and valuations aren't cheap enough to be compelling. The same is true in emerging markets, where slower growth and higher cost of USD funding both weigh on earnings outlook. And in fixed income, there is a stark yield gap between the US and other regions at pretty much all points on the curve. So they suggest being overweight in US cash and treasuries. Credit continues to offer reasonable carry, but the fundamentals for investment grade credit have deteriorated. US high yield is a relatively bright spot, but illiquidity risk is an important consideration this late in the cycle. What was interesting is they have three global themes. First, global policy divergence, where US policy continues to tighten. It lends support to USD, US cash. Other central banks are turning hawkish very, very gradually. Second, supply side weakness. We are seeing wage inflation picking up a little bit in the US, probably keeps Fed on a tightening path leading to a flatter US curve. And the third is technology, and we've seen a recent weakness in tech stocks, mostly on earnings expectations reset. They have three developed market themes. First, a maturing US cycle. Policy is approaching neutral and growth is slowing. So all of this is going to trend upside in US stocks, but in absolute, not necessarily in relative terms. Second is Europe. European growth has slowed back to trend and political risks are rising. and the euro is likely supported, but equities may still struggle. And third is Japan. Japan going beyond Abenomics. So corporate governance is improving, the BOJ policy remains easy, but there is little scope for further JPY weakness. It means that there is going to be limited upside. They have two emerging market themes. First, they see a convergence in emerging markets, and this is being driven by rising cost of USD funding. This is beginning to weigh on EM momentum. Valuations are cheap, but there are a lot of headwinds. Second, of course, China in transition, the 2018 growth data, and it's still very recent, so far is solid, but responses to the ongoing trade dispute is likely to dominate outlook in the early part of 2019. What was interesting is their take on main asset classes for equities and bonds. Since global growth is reverting to trend more quickly than expected, earnings revisions, some of these are falling. For duration, they say US yields are close to their estimate of fair value, and this brings growth concerns. Credit fundamentals are poor in investment grade, but they tend to be better in high yield. Illiquidity risk in late cycle is also a consideration. The other thing is commodities. So demand is a lot more balanced in energy for 2019, though of course trade is going to be a headwind for base metals. Real estate, they say, is holding up despite this late cycle environment, and some supply discipline has added support. Cash, they recommend moving overweight as real yields are positive, economic outlook is slowing. Coming to preferences by asset class, first equities. They say go US large cap, earnings growth is slowing, but quality of earnings and valuations remain supportive. On US small cap, they say domestic growth is reverting to trend, and there may be some boost from tax and fiscal stimulus that we anticipated, but that is fading. In Europe, ex-UK, economic growth is moderating. ECB is set to turn much more hawkish. EPS revisions suggest weakness. UK, defensive market, attractive yield valuation, but of course Brexit clouds the outlook for now. Japan, cash distributions are improving, but of course there's slowing global growth, which is a headwind for Japan cyclicals. Asia Pacific ex-Japan, Australian fundamentals, and I found that a bit surprising, are weak, but the sector mix is defensive. So emerging markets overall are inexpensive, but they are not cheap enough to offset pressure on earnings from trade and the USD. Moving on to real estate, the opinion on direct real estate is, of course, it's late cycle for real estate, but returns are holding up, but they prefer to say that let's take risk off, put it in US stocks. US REITs, some support if US rates remain in check, but the valuation support is less clear-cut now. And moving to sovereign fixed income, US treasuries, it has positive real yields along most of the curve. Rates may rise a little, but carry is good. Tips, recently there's been a jump in nominal yields led by real rates, so these things offer protection. And lastly, before I forget, on emerging market debt, they say attractive spreads versus US high yield, but of course global growth concerns are a persistent headwind, so they're not too bullish on that either. I hope this perspective has been useful, because in multiplicity of perspective, I guess somewhere exists nuanced investment truth. So at Active Allocator, we try to tease that out for you. Thank you so much for listening in, and I'll keep you posted. Bye-bye.